is the end of February, and as many of you may or may not know, this is Financial Aid Awareness Month. So, as we prepare to send our kiddos to college, it's kind of a good time to talk about college planning, college funding, how to pay for college, some do's and don'ts, best practices, things of that nature. So, I want to begin though by sharing a resource that we have. As a NAPFA advisor, make sure I've got the right screen coming up here. Um, we participate in what's called the College Affordability Project. And I'll share this link on my screen or on my LinkedIn as well for you all to use it. But how it works is basically a free report, which you kind of learn a little bit about. You get what's called a college money report that will tell you a few things about um, likelihood of college, how much it'll cost, things of that nature. But also, you can request a meeting with a NAPFA advisor. And we're a fee-only advisor, so we don't have any commission products to sell you. Things We're here to provide some service and some information to you to help you make some better decisions with that money as you're trying to get your kids into college. So that's step one. Step two today, though, we're going to focus specifically on um, some strategies for our what we call. Let me get it pulled up here. For high income earners and high net worth business owners. So I want to talk about some strategies here to use, and we'll go through a real life example of a family and what to expect. So one of the biggest problems is the most dangerous words in college, as we say on our side of the fence, is if you get in, we'll figure it out. Well, as we delve down into our examples a little bit later, you'll see kind of how dangerous it is if Haley, as in our real life example, gets into MIT or Stanford, and now the family's kind of scrambling to try and figure out how they're going to pay for it. Ideal world, college would be pre-approved like a mortgage. We probably would not have some of these college loans out there that we do today. All right, so what are you going up against? Again, on our side, we call it the meat grinder that is college. There are three entities that you're battling. You're battling Wall Street, the federal government, and higher education. And believe me, all three of them have done the math, and they're going to win on this transaction. They're not in it not to make a profit. All right. So what can you do? Step 1 through 6 here. You can read those on your screen. Prepare for the cost of college. Apply for admissions. Got to apply for financial aid to qualify for a lot of these scholarships and grants at these universities. Analyze and appeal your decision. We'll talk about that as a strategy down the road. Choose the right school, accept your award, and now figure out how we're going to cover that shortfall. All right. So the biggest thing you need to know is how that school runs their business. And you learn that from their financial aid policy. So we're going to talk about how to interpret their financial aid policy so you understand how they actually run their business. Problem that we have with most kids who are coming from high income business owner families is they have high merit. So they are skilled, very smart kids, achievers, high achievers, but they have low financial need, which again, when that what is called that student aid index is calculated and the need comes out, a lot of times that need is zero from the way it's calculated. So now how are we going to fund that gap? So again, as we're talking about here, what's called the college crystal ball. The cost of attendance minus the student aid index gives us the amount of need that we need. One rule of thumb that we like to keep in mind and share with people is your total student loan debt should not be greater than what you will make your first year out. This will keep your loan payment affordable. So if you're going into a job that's going to make $120,000, your total student loan debt should be $120,000 or lower. That will keep that payment affordable for you when you start working. What we're going to be concerned with is the net price. Again, you're going to have the cost of attendance up here, but we got to whittle that down to the net price. That's what we're going to be concerned with, what you're going to pay. My daughter went to Gardner Webb, played volleyball, and again, we had a cost of attendance price, but because of academics and athletics, our concern again being the net cost. What are we going to have to pay for her to go to college? Now, one thing, as I said, battling against higher education. If you look at this last sentence here, um, you'll hear things like, "Oh, we haven't raised tuition in 5 years." Again, inflation is hitting them too. They raised something, and what they raised was room and board. So they just moved that, line item from where we're going to raise money, where we're going to market that we haven't raised tuition, but room and board went up. So they're going to get their money from somewhere. All right, we'll get to the planning opportunities and strategies after we take a look at the family that we want to take discuss. Okay, so here we have a family here, and again, as we start out, we were talking about if you get in, we will figure it out. Um, Haley here has gotten into some really good schools here. Um, so we're going to figure out what Haley's and her family's future looks like financially in paying for 3 different types of colleges. All right, so family's doing really well here. We have the Dumphies, as we've named them. We have Mr. Field, who's a realtor, and his wife is a consultant. They have a net worth of about $3 million, and they have the 3 kids that they want to put through school. All right, so again, we call this the college nightmare. Here we're talking about Penn State. Big Ten schools, you're not getting anything off of tuition. So just know that up front. They are very proud, very prestigious, and you're not getting anything off of that cost of attendance. In this case, we're looking at a net need for Haley of $120,000. So if she finances that 120, she comes out paying over 10 years, $1,335 a month at a total cost of 160. More than likely, she's going to go, "Oh, that's too much to pay. I'm going to pay $775 a month over 25 years. That's going to cost her $232,000 to pay that loan back." She's a computer science major, so her estimated take home when she graduates is $45,919. That's almost a third of her income here when she's right out of college. So that's a lot for her to take a hit on. So that's why it's really important for us to look down the road and make sure we're teaching our kids what this means as they are trying to make this choice of school. So again, the things we're paying attention to are the academics, financial aid policy, and the family's financials. Again, as we stated earlier, generally your kids are high merit, low need. And again, so now we're looking at some merit-based schools. So we've got, we'll take University of Denver here, as well as University of Alabama. And then we've got some schools where 100% of the need is met. So again, that's your high merit, high need kid that's going to get those loans. The high merit, low need kid is not getting anything from Stanford, Harvard, Notre Dame, Northwestern, MIT. That's a full price. You're gonna pay full price. Only people getting scholarships to those schools are you may need to be 6'5", 240 and run a 4.2 40, play on the football team or play on the basketball team. They're getting scholarships. Our kids aren't. All right. So as we look at these 3 schools, we're gonna look at Stanford, Alabama, and Denver. So University of Alabama, cost of attendance, $55,916. University of Denver, cost of attendance, $83,310. And Stanford, $94,392. So yes, we are on the race to $100,000. Somebody's going to break that pretty soon. What do we like? We like the grid, automatic. Competitive is when you are battling all the people going to that school for those presidential scholarships, and they give out 1 or 2 full rides for a 4-year scholarship. Probably not going to get that. Package can be a little tricky, so you have to pay attention to those. But what we like is the grid and the automatic. You do this, you get this. And here's what we're talking about. So University of Alabama, you're going there, you're from out of state. This is 2023. But you hit this test score, this GPA, this is how much money you get, you know. So that makes it easy. This is why it can be a good idea to invest in test prep. Spend a little money here, get that test prep up. Look here, if you pay what, $500 for some test prep, you might get $4,000 a year if you can move that kid from here to here. So well worth the investment. So as we said, Stanford, no scholarships unless you're 6'5" again playing a sport. So you're talking about paying $395. So as we look at these three schools in general, after we subtract off the cost of from the cost of attendance and get down to the net, at Alabama, you're probably looking at paying $121 over 4 years versus Stanford, where you're at $395. So you want to really do your child a favor, take that 121 minus 394, that's 278 out of pocket. Take that 278 and invest it in the S&P 500 for them for forever. That really sets your child up for success, not spending the 278 today. Okay, so that wraps up that piece. So let's get into a few strategies that you can really employ to help as a business owner specifically. All right, so one thing you can do is reposition those 529 assets to grandparents. Now they only count them in the kid's name. So if you can move those there, that's good. Pre-tax 401k contributions, I'm gonna skip over analyze and appeal for a second. But the pre-tax 401k contributions are great. They used to add those back to the student aid index, but now they don't. Gift appreciated stock to avoid capital gains tax. So if you've got stock that's worth something and it's got capital gains, gift it to the kids in a 0% bracket, let them make the sale. Now you've got cash to help pay for college. Analyze and appeal. So this is good, really works for probably those D2, D3 kids who are going to play a sport. So what we're going to do is we're going to apply to some schools that we know you don't plan to attend, but we just want to get the award so we can compare that award and maybe share it with the school that you do want to go to, such that they will meet that and match that, because they will a lot of times. Remember, those private schools need heads in the bed, and they are going to do everything they can to get that child there. And then finally, some other things you can do as a small business owner. If you got rental property, you want to get it in a business because that will reduce the value that they assess. Hire your children, of course. Many business owners already do that. So they hire their kids, shifting them to a 0% bracket, putting money over there. Finally, educational assistance programs. Kind of got to be careful with that because you can't discriminate. But the idea is to hire your children. You can pay $5,250 per year towards an educational assistance program, and that reduces your business profit each year because it's a business expense. So those are some strategies that we can employ that we use over here to help you figure out how to make college more affordable, how you use your resources a little bit better to really make an impact for your child. So until next time, talk to you later. Thank you.